Hello everybody, this is Gary Follett, having a little YouTube video of why the importance of Richard D. Wyckoff's work in today's markets and in the past markets. The principles of Richard D. Wyckoff have been used for over 100 years. It's based upon price and volume. Price and volume are the only two indicators that are live and that are real as the market continues to go forward. In other words, RSI, ADX, all these stochastics, all these forms of indicators are lag indicators. The market has to make a move, and then these indicators will kick in. They're very good when they have a situation in which markets are trending. Since most markets do not have a significant trend most of the time, sometimes this is where they get caught in markets. So we want to have a way of looking at markets that show price and volume, again, which are the only two situations in markets that are real and live. I can tell what the volume is, especially better now with electronic trading, and I can tell the price movement, the bar of length to the markets. This is very significant to make a decision as things are happening versus waiting for an indicator to happen. I believe that every trader understands Wyckoff principles, they just don't recognize the name and the way they do it. Richard D. Wyckoff did not invent anything, but he watched the minds and the greatness of the people around him back when he traded. People like J.P. Morgan and Jesse Livermore, Keene. These people were great operators at the time in the early 1900s, and he watched their work and watched how the markets operated. These principles can be used in economics and everything that we do, and they cannot be denied because they exist in principle form, not in theory form. Those three principles are on top are effort versus result, cause versus effect, and demand versus supply. All equally significant, though we get different viewpoints from each one of these particular market phases and market principles. So the first one is effort versus results. This is a situation would be if a stock went up $1 on 1,000,000 shares, we have a guideline, a baseline of what the market did for that day. If the next day the market went up, or the market did not go up at all on 10 million shares, we can see that the effort to try to move the market up failed, because 10 million shares failed to move the market, and this is what we call an effort versus result. The market worked hard to go nowhere. We compare the two bars and the volume together to see if they match up and line up. In this particular case, the extra volume and the lack of movement show that someone was stopping the market. It's effort versus result. The cause and effect is the horizontal trading range that a market trades in. In Wyckoff, we don't use the one line trend line as anything significant because demand comes from areas that are reactionary lows and reactionary highs. So in this particular case, market has formed a particular trading range, and we look at this, and the longer the market goes sideways, the larger the cost becomes. It's akin to having gas in your car. The more gas you have in the car, the more potential the car can go. The longer the sideways action in trading, the larger the potential move can happen. Demand versus supply. This principle is based on the length of the bar and the volume that occurs behind it. An up bar that goes up a little bit higher, we call that a buying bar. A bar that goes down a little bit, we call that a selling bar. If we get a market that has large volume and large range to the upside, we call that a demand bar. A market that goes down with large range and volume, we call that a supply bar. This is significant because this is when the ease of movement to a market is either up or down, respectively. So when we see demand and we see supply, we see that one of the market forces are in place. We understand that there's buying interest to the demand bar. We understand there's selling interest to the downside. all very significant, all very important in Wyckoff. So again, these principles are, over time, have proven to be very successful in how markets work. Trading is very, very difficult, but with these three principles, we can get an edge to the market, and we can see what the market internally is happening, versus waiting for some type of indicator to take place. This is very important to understand these principles in order to understand markets. So this is one of the best ways, in my opinion, that we can look at a market live, real time, without any gimmicks of some type of stochastic or ADX that it may be difficult to follow if the market begins to change direction. Because you have to wait for the change in direction for the indicator to turn up or down. And that could be costly. By watching price and volume, we can actually see what is happening live at the minute it's happening. So I want to thank you for taking your time to watch this video in Wyckoff. This basic principles of Wyckoff principles are the three ways that Wyckoff believes the principles work of markets. I want to thank you and hope that you join us in future videos. Thank you very much. Have a great day, everybody.